So this is going to be a three-part series where I talk about some of the most talked about and popular electrical vehicle companies. The three companies that I will be analyzing are Tesla, NIO, and Workhorse. I will start off by doing Tesla just because it is the most popular and the one with the highest market cap out of the three. And the reason why I decided to do this is because I think that we're seeing a lot of patterns in the electrical vehicle industry that we've seen before. And what I mean by that is that some of the patterns and sort of valuations that we're seeing right now in these industries are really similar to what we were seeing in the dot-com era and sort of like that huge bubble. And I'll talk about that a little bit later, but we're going to go ahead and start off this series by reviewing and analyzing some of the numbers that Tesla has on its balance sheet. Welcome back to another video. As always, if you enjoy the content, make sure to leave a like and subscribe. So as I mentioned, what we're going to be doing today is going over some of the numbers that Tesla has on its balance sheets and sort of just giving my overall opinion about the stock and its current price. So we'll start off by going what the current price of Tesla is. So it closed on Friday at $585.76. It dropped about 1% or 0.17% or $1 in after hours trading. So it had a 2% gain just on Friday, so pretty good. But let's sort of unwind the stock and go back a little bit and look at what its total year-to-date change. So it started off the year trading at $86.05, and as you guys can see, it shot all the way up to $585. Its 52-week high was actually experienced on Friday. It went as high as $598.78, so just shy of $600. And so from January 1st to November 28th, which I think was Friday, I could be wrong, could have been 27th, but from year to date the change has been 679%, and that is an astronomical return for any stock, not just electrical vehicles. You know, any stock moving that much, you'd expect it to have some really good numbers in its balance sheets, and you know, you'd expect a company of that caliber to be providing some pretty good numbers to back up that huge change. So we can go ahead and look some of the numbers that Tesla has produced and see and give you guys my personal opinion on as to whether the numbers that it has produced back up that 679% gain year to date. So in the last quarter, Tesla sold and produced 367,000 cars. If you take out the calculator and divide that by 3, it's going to give you the average cars sold per quarter. So that divided by 3 comes out to about 122,333 cars sold per quarter. That's relatively high in the electrical vehicle industry, but that's extremely low in the vehicle manufacturing business, because there's the gas producing cars, you know, those are producing millions and millions per quarter. But we're going to stick to sort of just electrical vehicles because this is what we're going to be talking about. So in a press release, Elon Musk said that his goal for 2020 was to produce and sell 500,000 cars. So we go ahead and do the math right now on that. I think that comes out to about 130,000 cars he needs to sell in the next quarter. Let me just do 0. So 133,000 cars needed to sell in his last quarter. So normally 10,000 cars more than the average rate that you've been selling in the past 3 quarters wouldn't be a lot, but because this is 2020 and there's a lot of stuff going on, including the pandemic, I think that to continue the current rate and to sell more than the current rate actually is going to be definitely harder than in any other year. If we go ahead and look at some other statistics by vehicle sales in each quarter through the past couple of quarters, we can see that it normally hovers around 4.5 million. You see that's a consistent trend. However, in quarter of 2020, quarter 1, we can see it dropped all the way to 3.5 million, and then quarter 2 it dropped all the way to 2.9 million. Quarter 3 is still not done, even though Tesla already reported quarter 3 earnings, but there's still a couple more companies that need to report quarter 3 earnings, so that's why quarter 3 has not shown up yet. But you know, my guess would be that it would drop from 2.9 somewhere to in between the 2.5 and 2.9 range, just because the pandemic has been rapidly progressing and getting sort of, I guess, not necessarily worse, but I guess the economic deficit has been growing, so that means that there's a lot less spending. So I think it'd be pretty reasonable to expect that this 2.9 million dropped. But going back, like I said, I don't think it's gonna reach its goal of 500,000 cars, and another reason is because like I said, in quarter four, there's a lot of holidays coming up. Black Friday just passed, Christmas, New Year, so there's a lot of gift buying in general by the economy. And my guess is that after all this gift buying, there's going to be a lot less money left around to, buy a new car or something of that sort. So that, in conjunction of the whole pandemic and less money going around, is going to be harder for Elon Musk to hit his goal of 500,000 cars. So next up on the list right here, we have price to earnings. So this is the price to earnings ratio of 1,172. And so that is an insane price to earnings ratio. So for comparison, Apple, one of the most valuable company based on market capitalization as of right now, has a price to earnings of 35. And in general, the SPY has a average price to the stocks in the SPY have an average price to earning ratio of anywhere between 10 to 20. So that's considered normal. A price to earnings ratio of 1,172 is beyond normal. So this means that the current price is trading 1,172 times greater than what the earnings that Tesla produces. And so that to me signifies that this stock is extremely overvalued. And we go ahead and look at something that has happened in the past of a unreasonable high price to earnings ratio is Netflix. Let me go ahead and just search it up. A couple of years back, Netflix had, when it was investing in these the shows that is its own shows that it was producing, like Netflix originals, it was burning through a lot of cash and a lot of debt to do so, and the stock price was rising considerably higher, but the actual earnings were not. So we go ahead and look at the 5 years, because this was about 2 years back. We can see that a couple years back, Netflix was trading right around the 80-ish area, and then it jumped all the way up to $400. That huge jump caused its price to earnings ratio to skyrocket, and after it did, people slowly started to realize that the current price of Netflix was not in conjunction with the actual earnings, and so that caused a huge drop from the 400 area all the way down to the 250 area. Currently, Netflix still has a relatively high price to earnings ratio, and like I said, we've seen these sort of patterns continue to repeat themselves when a company has a considerably high price to earnings ratio. The earnings don't go in conjunction, and so that leads to investors, sort of thinking to themselves whether or not it's a good investment. And for the most part, when there's a huge difference in price to earnings ratio, it's not a good investment, because it means that the stock and the company is extremely overvalued. So I don't want to get too much off topic talking about a different stock, but that just goes to show why a price to earnings ratio that high is unreasonably hard to justify, because the earnings are not pairing up to what the current price of Tesla is. And so the next thing that I have on the list is profitability. So a lot of the newer electrical vehicle companies, they're just brand new, so they started in the last 5 to 10 years. Tesla has been going on for a little bit longer than that, so it has had more, I guess, a bigger timeline to produce a profit. And so in the last quarter, Tesla produced a $331 million profit. I think it's currently its 5th quarter where it produces a profit. And that, to me, is a good step in the right direction. So this whole video is not just going to be me bashing on Tesla. It's going to be just reading about the facts, and profitability in any company is a step in the right direction. However, there is some caveats to that profitability. So there's only $331 million in profit, yet the stock price does not really represent that. And what I mean by that is that its total market capitalization right now, we can go ahead and look down at the list right here, is 555.24 billion. So it has an insane market cap compared to the actual profit that it's producing. So it is going in the right direction towards profitability, and I do expect this to increase. However, the current price and just the current uptrend and year-to-date change do not justify the current profitability that it has. Maybe if this was higher, maybe in the couple billions, maybe 3 to 4 billion, then maybe this price would be justified. But as of right now, the profit of 331 billion is not justified by the current price of 585. So the next thing we have on the list is the total debt. Right now, Tesla has a debt of around 13.1 billion, and that is extremely low in the electrical vehicle industry and in the car industry in general. But that it comes with a caveat again. So the reason why Tesla has such a low debt ratio and debt in general is because the way Tesla goes about raising funds is slightly different than most companies. See, most companies usually take on debt to produce and work on different projects. Tesla has been selling equity instead, and so that is a good thing, but that's also a bad thing in the long run. So there's its pros and cons about that, which I'll talk about in a different video. But to sort of summarize it in a fast fashion, what that means is that Tesla and Elon Musk is selling his stock shares in order to fund the company. And so as of right now, that's helping the company because it means that there's less debt that it has to take on, less interest, and less overall obligations. But that also means that in the long run, Elon Musk and Tesla stockholders are losing control of the company. And so in the future, if there's a big decision to make, Tesla and Elon Musk might have a lesser say in it because he controls less. Right now, I think he controls around 21% of the company. So in the next couple of years, that might not, in the next year, that might not be that big of a deal. But going forward, if there's a sort of an issue or something that needs to rise and there's a lot of cash involved, he's probably going to have to raise that debt. And because he might not want to lose control of his shares, he's going to have to increase debt. So I think the total debt right now, 13.1 billion, is really good. But I do see it rising in the foreseeable future because I don't think that Elon Musk is going to want to sell more of his shares to continue to fund Tesla, especially because he has other companies that he has to work and manage. So it's going to be interesting to see how Tesla handles its current debt. So the next and final thing on the list right here is the market control. So what this means is that out of the electrical vehicle industry, how many cars are sold in general, what percentage of those cars are from Tesla. And so as of right now, Tesla holds about 81% of the market in the electrical vehicle industry. In the general vehicle industry, that number is a lot smaller, but because electrical vehicles is sort of its own niche that continues to grow, as of right now, Tesla owns the majority of the control in that industry. And that is really good for Tesla. But the bad thing is that because more and more electrical vehicle companies are starting to come up, this market control is going to drop significantly. As of right now, Tesla has the most cash on hand and most market capitalization because it's been around the most and it has the biggest popularity. But in a couple of years, when the electrical vehicle industry starts getting bigger and bigger, this number is going to continue to drop. And as of right now, it's kind of hard to say how much it's going to drop because most of the electrical vehicle companies are still sort of in the making and are yet to release a stellar car that has the same sort of mileage and features as a Tesla. But as the technology advances, I think that they're going to be able to produce similar, if not better, cars than Tesla. And so the market control from Tesla is going to drop, and that's going to affect the company a lot because it's going to sell a overall smaller percentage of cars to the economy, and so that's going to affect the total control that Tesla has. So to wrap this up, in my opinion, I don't think that the numbers that Tesla has produced in the last couple of quarters justify the current year-to-date change. I think Tesla is significantly overvalued, and as I mentioned in a previous video, at this point I don't think it's a matter of whether or not Tesla is going to drop significantly. I think it's more of a matter of when is it going to happen. So that's pretty much it for this video. I hope you guys enjoyed, and I will see you guys in the next one.